town meeting before its time is just asking for trouble. So so if we're going to bring something to town meeting, I really want this committee to really form a consensus and have a good concrete proposal that's been substantially negotiated and memorialized in whatever documents are going to be memorialized. So, with all that said, Pam.
Thank you very much. And I'm going to just hand out some notes so that we've got some things to follow as we go along. These are sort of my cheat sheets.
Well, this is what we received electronically, right?
Yeah, probably is. For those of you who have printed it out already, you shouldn't see anything different. It's what I sent over to Francisco late this afternoon. What I've tried to do, and I'll just, what I'd like to do is to sort of walk through what I've done in relation to the scope that we agreed to some number of months ago, and sort of answer the questions that were posed by the scope. That's kind of how the scope got presented to me. Can you help us answer the following questions? And so that's both how I approached the analysis and also how I've sort of structured my notes here. And I'll just say, procedurally, process-wise, I've tried to answer these questions, but I've also had quite a bit of interaction with the developer in looking and reviewing their pro formas, their numbers, cost pro formas, operating pro formas. Had an opportunity to ask questions about those and to probe on various things. For both the as proposed project as well as for the 40B project, because it's important, I think, in your questions suggest it's important to understand what the differences are between those two, what makes one feasible or what makes them both feasible in spite of their differences. And then I've done some, I'll call it noodling around what could be done to try to shrink the size of the project. What are some ideas that might yield, apart from a massive 40B across the site, what other approaches might yield some movement on mass and height and so on? And I will say that, I don't pretend to be the sole arbiter of what those alternatives might look like. I've tested a couple different things, and I think it would be of interest. It sounds like once you have had some interaction with the architectural committee, because I'm certainly not an architect, it would be helpful perhaps to explore other alternatives than the ones that I'm going to present here as perhaps ideas for going forward. And I'm happy, of course, to test other things that may arise as part of that process. So, one of the first questions that was posed is just, a hotel. Aren't there a lot of hotels? What do we think about the hotel market? How much depth is there? And importantly, how much of an impact might we expect an additional hotel in Coolidge Corner to have on the existing hotel stock, especially in Brookline? Because, of course, we would not want to invite another hotel to the detriment of the performance of existing stock. That doesn't do anybody any good. And so you may or may not know, I've run the valuation department for Pinnacle Advisory Group, which is a hotel consulting outfit, and I look at hotels all over the place. And I had occasion to talk directly to Rachel Roginski as a way of trying to probe more on the hotel market, Brookline market. She, as you may know, is doing the hotel feasibility work for virtually every hotel that you can name. And so she's in a position to have been in and around the data sets, the comp sets, etc., in evaluating the hotels that are being proposed in Kenmore Square, for the hotels that are being proposed out Route 9, and it has just a lot of familiarity with specific performance metrics and, importantly, supply-demand forecasts. And we went back and forth on with questions around Coolidge Corner, and the long and the short of it is the hotel markets are extremely robust right now, and likely to be for the foreseeable future, at least as the forecasts of demand, travel, leisure, business, and what they call Smurf demand, which is social, military.
Smurf.
Yeah, it's a horrible acronym. So I never get it right, but it's essentially educational demand, healthcare demand, social demand, fraternity demand, that kind of demand. The categories of demand are growing across the board, and Boston and Brookline, especially with the sort of nexus around Longwood as a demand source, that constellation of demand sources and competing hotels, there's still not nearly enough rooms to satisfy demand, and we're far undersupplied relative to existing demand, let alone demand that is anticipated to come over the next several years, especially in relation to what's happening in life sciences and in healthcare. That the arc of that employment and the induced demand that comes from our standing, if you will, in the healthcare and life sciences environments, and this is even without consideration for what happens if, I don't know whether to say God forbid or good, whether Amazon comes or not, but there's that underlying demand is going to fuel, we think, a continuation of this supply-demand imbalance. So I think what's interesting, the other important point is Coolidge Corner is an extremely attractive and appealing location for a hotel. More so than out Route 9, more so, frankly, than Kenmore, because of a variety of things which come as no surprise to you. The quality of environment is very high. The retail and entertainment venues are mature and organic. It's not an invented place as we find in some other places where hotels are being developed, like Seaport and some other places where you just don't have the experience that the hotel customer is looking for. And because of access to transit, there are things about the location which are especially appealing from a hotel customer point of view and from a hotel investor point of view.
Pam, there are chairs out there.
I'm fine, thank you so much.
Just pains me seeing you stand.
I prefer to.
Okay, that's up to you. Okay, sorry.
So the short answer is there's enough demand to support another couple hundred rooms in Coolidge Corner. Probably you could do more than that, frankly, if you chose to, or if you had a site that was large enough, or two sites, because the sweet spot and the product preference is really for select service, locally based. Think Marriott AC, think Hilton Canopy. There are evolving in the hotel chains beyond just sort of select service where you don't have necessarily a full boat food and beverage operation. There is a lot of attention being paid now to the local experience for the customer and the desire to externalize the sort of more typical sort of full service activities that you would find in the first floor of a hotel, like food and beverage, like the boutique, whatever, to the outside market, and that enables you to brand the hotel as more of a local product than a standard chain product. And that product, of course, is a real match to Coolidge Corner. different than a highway hotel, which is also in the select service category. A lot of the new ones are on the highways are in that category, but of a more again locally curated kind of experience for the customer. So the location is especially good as it relates to impact on existing supply. Whenever you add a hotel to a market, there is always an impact. It tends to be short term, however. With a market that has more demand than supply, you will see invariably some kind of a short term effect as the market absorbs the new product. But generally speaking, that's a 2-year kind of proposition as the ramp up in the new product occurs, and then things stabilize and the effects are neither permanent nor substantial typically. And so I guess what's important here is that there's room for it, but you should not expect that everybody's going to go like so as the new product is added to the market. There will be a short-term effect. It's a fact of life. Customers test out other things that haven't been in the market before, and as hotels find their niche, those impacts, generally speaking, dissipate. And that there's no reason to expect that this experience would be any different. So that's not a short answer to the question, but that's that's an answer to the question. And I guess maybe the last thing I'll say about hotels, and then we'll move on, is just, how big does a hotel have to be? What is its typical sizing? Select service hotels, generally speaking, want to be somewhere around 175 to 200 rooms. I mean, that's sort of the sweet spot for a select service brand. That's the efficient size that they are generally seeking. And so, having said that, I would never want to be the one to say, nope, 201 units is too many. Or 174 units is too small. It's more a function of how the design meets the site and how the relationship with the hotel operator, what that preference looks like for a location. And again, I think there's some flexibility in sizing that relates to, again, how does design meet the site, and so I think that's open for some discussion. Again, it's my understanding at least that the hotel itself as a contributor to the economics, and we'll get to that in a minute, it does make a useful contribution to the economics, and the size of the hotel, at least its height, it has, at least as I understand, has not been as troublesome as the height of the apartment building. So I will simply say that I've focused most of my analysis and testing, at least as far as alternatives go, on the apartment side of things, but I will say some things about hotel and what the hotel contributes to the underlying economics for the whole, because it does make a contribution. So that's really as much as I'm going to say about hotel.
Do you want to
Can we ask questions?
Yeah,
I have
sure.
the same question.
Yeah, go for it. Yeah.
I just want to clarify, so the Pinnacle advice, just so people aren't confused, Pinnacle actually did the report that we received a copy of for the 1200.
For 1200,
They
yeah.
did not do the one for
Right.
for the Waldo Durgan site that was done by HBS.
Yes.
So,
Right. Exactly.
So is this too detailed that start asking questions about whether you think the assumptions in the HBS report are reasonable in terms of, as we look at this as a committee, one of the factors that's always put forth on hotels is their attractiveness for tax generation with the occupancy tax. And do you find those both
Yeah.
reports were relatively close in
They're
assumptions? Do you
very,
find them?
they're very similar. I don't think that we would argue with the ADR estimates or the OCC estimates. And, as regards the tax potential, meals tax, rooms tax, I'll confess, I haven't calculated that for the current proposal, but that is something that I should probably do.
About $3,900 a year per room.
Yeah, which, I think that's within on a per room basis, that's within what we would typically see for what's supportable on a revenue basis. But I haven't applied the actual metrics from the state to the Coolidge Corner proposal as it sits, but that's a calculation that's easily done.
And $3,900 for all the taxes or just the meals tax?
Yeah, the occupancy excise tax.
For everything?
Yeah, it's the.
That's not the real
Not
estate
the-
tax, that's.
No,
Right,
that's
now I
not-
understand,
yeah, that's not
but
real estate
Pam
taxes.
was also talking about the meals tax as well as the occupancy tax. I didn't know if
No,
that
that was-
$3,900 was including something like a meals tax as well.
No, it's
Okay.
occupancy.
Occupancy tax, okay.
And that's obviously a function of.
Linda?
Yeah, the
Right.
meals tax component is very tiny.
Yeah.
It's
Okay.
really tiny.
Linda?
Yeah,
On the
I had two questions.
Yep.
I guess I'll just tell you both of them. You can decide how to
Yeah.
answer. So you mentioned that it kind of mattered about how the hotel fit on the site and the design, and I'm wondering if visibility matters here because we're kind of not going to have the same visibility. And did you factor that in? And then my other question is just generally, what about Airbnb? I mean, is Airbnb like taking up this excess demand? What happens when we regulate it? How are the consultants who look at hotels thinking about that?
Yeah, well, as far as the visibility is concerned, this hotel is going to have a marketing presence, and it's going to be branded, I'm sure, as a Coolidge Corner hotel. I don't think the market's going to have any difficulty finding it.
Mm-hmm.
I think there's good evidence to suggest that the other hotel in Coolidge Corner doesn't have visibility either, and that one does all right. So I think that's less concerning. I guess when I say design and how it meets the street, it's really just a matter of how many units can you actually fit
Mm-hmm.
on the site in a rational configuration
Okay,
with the loading and back of house and window line and all of those things that matter to a franchisee. I guess I don't mean design in the sense of necessarily quality of it. We expect it's going to be quality. It has to be. But it's really, whether it's 200 rooms or 210 rooms or 190 rooms, frankly, is more a function of how the design works and the massing and scale. There are thresholds below which you should not go, just in terms of sizing. As I said, that 175 to 200 room bracket is in the ballpark of where that select service hotel type wants to be from an efficiency, management operational efficiency point of view. So going to something really tiny or going to something really big doesn't really work.
Okay.
But within that band, with some flex on either end.
So assuming it fits is what you're saying.
Yeah.
So
assuming it fits,
the
yes.
view out the window doesn't matter?
Not really, not given what people are, people use hotels now as a place to go to sleep.
Okay.
And, I don't know if you've recognized the ever shrinking hotel room phenomenon, but if you spend a lot of time going from city to city, the hotel rooms are getting smaller and smaller and smaller and smaller, and people are trying to externalize the hospitality experience to the outside the room. And so we have excellent hotels that overlook highway ramps and that back up on the parking lot of the Whole Foods, or so that's, I suppose if you're in New York City and you want to see the park, there's a view premium for that, but but this isn't the kind of market or hotel type that cares that much about view.
Catherine?
Yeah, I just had a question about this robust demand.
Mhm.
To what extent is it accelerating faster and higher than the curve of construction costs?
It's on par or faster, actually. Faster than resi. You know, that's one of the conundrums of residential, the multifamily market today, is that, you know, rental rates are still, surprisingly, still escalating at 2 to 3% per year, but construction costs are escalating faster than that. Hotel rates and really RevPAR is escalating 5 to 7%. You know, that's been the pattern over the last several years. Now, that doesn't mean that there aren't some,
Sure.
you know, bumpy spots, but the hotel market, I suppose, because of the sort of more extreme undersupply, has and because the occupancy rates were low and those are jumping, so the rates are growing, but it's the occupancy that's really growing. You know, average rates occupancy today 80%.
Wow.
I mean, it's crazy. And so you start to do that math, you know, looking at the escalations on the RevPAR line, and it's really quite something.
So how do you factor that into your projections and your model? If your revenues are accelerating faster than your costs?
Well, when you model, you never model that way. That's the underlying answer. The answer is anytime you model on the assumption that you're going to get operating leverage, you're tempting the fates. and you know, so analytically, the convention that the underwriters use is income grows at the same rate as expenses grow. And so you're you know, you have to be very careful that you know, while we see the pattern in the rearview mirror, and that gives us confidence about the ability to maintain feasibility for construction underwriting, you never model operating that way. No.
I understand, but does the operating return not influence your capacity to meet your debt service?
Well, it's a matter of how much risk. I mean, I guess the bottom line is nobody bakes that risk into the underwriting, or the optimism on the flip side, that optimism into the underwriting. Now, achieved returns are different than pro forma returns, right? And so sometimes it works out that you find if you hold it the right way, or you hit the market at the right point in the curve, that you make more money than you've underwritten to. Hopefully that's frankly how it turns out. That's actually what developers are hoping for. They never want to be at pro forma, actually. But you can't convince a lender to loan you money on that basis. I guess that's the fundamental point.
Elk?
Is that why, maybe that explains my question, which is if the demand is so exuberant, why the return is on the low end of feasible?
Because it's very expensive. I mean, those costs are, I mean, you know, underwritten to current ADR and occupancy, underwritten to the current expenses, underwritten to Boston construction. You know, the local conditions don't deliver dramatic returns. You know, they just don't. And what's interesting about hotels, and this is different from the multifamily world, is that hotel owners and operators tend to, I don't know how to say this exactly, but to just say it, they tend to be a little crazy. You know, they tend to do things for the sake of the iconography or the contribution that a particular hotel makes to the
I
larger.
don't have anyone in mind particularly.
There are a few, and we know who they are.
Yeah.
It's very interesting. The degree to which we see hotels trade, and even in hotel investors accept equity returns that are just ridiculously low. That doesn't mean that the lender will go along with that, but on the equity side, equity participants.
The room rates that you're assuming in the model are very competitive then, and
Yes.
have to be. you're
Have
saying,
to be to get the underwriting on the debt. And of course, equity is not 100% of the capital
Right.
stack. It's a very small part of the capital stack. And so a part of what happens, especially on the hotel side, is, some willingness to let things ride in anticipation of a payday down the road. So there's more of that kind of behavior generally in the hotel investment side of things than we find in the multifamily side of things, which tends to be much more about institutional money, much more about, rigor in the underwriting. Thou shalt not do it. We won't do it if it's a 100th of a basis point, lower than our threshold. I mean, we've seen deals just blow up for the sake of a 0.1%, glitch on the return on cost. So, but that's a function of who the money consists of, and the differences, both in sponsorship but also on the debt side.
And then
Just have a
I'd like to
final
try to
Yeah,
move
sure.
thing
on
in
to
response.
the Residential.
So should I conclude that these underwriters update their models using the empirical data of what's going on in the market on a regular basis
Oh, yeah.
to reflect this, just the one differential I'm talking about, which is the rates versus the construction costs.
Yeah,
So that's a dynamic.
Yeah, nobody is using the standards from 10 years ago or from 5 years ago. Everybody's forward-looking, trying to anticipate. But there is a certain, on the debt side especially, a certain conservatism.
Yeah.
It's just part of that world, which is, again, developers are in the business of being optimistic,
Mhm.
right? That's the profile. But the debt side is not so much that way. It comes as no surprise really that in creating a project, 80% of the money or 70% of the money is coming from the conservative people, and often as little from the actual development sponsor, often as little as 5 or 6% is coming from the. So you can afford to be exuberant if you only have 5% of the project at risk. It's easier to be more optimistic, I think, with that kind of
So we can
participation.
expect irrational exuberance from
Well-
Chestnut Hill Realty.
Or I think it's again, it's a developer mindset. I think that there are some things that are different about Chestnut Hill Realty, and I'll just say that often what motivates the sort of merchant builder developer is conservatism, because we got to get our return right away, and need to be able, the minute stabilization hits,
So,
it's on the market and we're exiting, and actually that's our payday.
mhm.
But I think there are some owners, some sponsors, some investors, and I would put Chestnut Hill in this category, that have a longer term view, which I think enables a certain flexibility, we'll say, in terms of proceeding with returns that maybe the other kinds of investors would not accept. And we'll get to that in a
Okay.
minute, but I think that's an important point, and I'll make it again in a little while.
Sorry, but
Yes,
you
go
didn't
for it.
answer the Airbnb question.
Oh, Airbnb. So Airbnb is definitely having a disruptive effect on the hospitality industry. There's no doubt about it, and I think that unregulated, it's likely to continue to have an impact, and not just on the hospitality industry, but on the rental housing industry. And you know, in Boston, as you know, they've just recently passed some laws to prevent investor-owned or investor owners from putting their rental units to the Airbnb pool, so that it can be what it started out to be, which is really an owner-occupant way to make a little more money. Renting a bedroom or renting another unit in your triple decker. And I guess I would say we'll see what kind of effect that has on Airbnb in Boston. I guess fundamentally especially in the downtown core market, that supply-demand imbalance is sufficient that I think the impact from Airbnb is, it's an annoyance, it's worrisome, but I think the regulation is sort of tamping down that worry and concern. Out in the suburban markets where and I'm not sure, I wouldn't characterize Brookline as a suburban market per se. It's really a part of that Boston Cambridge urban market. But in the suburban locations, think 128 and some other places where Airbnb is operating, those hotels are much more tenuous in terms of how they operate and how thin their cash flows look relative to debt service. And so I think it matters sort of where you are in the hotel realm, whether you are going to really feel an impact or whether it's more perceptual than real. In Boston, I think it's more perceptual than real.
In the model, do you account for the risk of something happening with the biotech boom?
No, we assume that happy days are going to be here, and I think that's not to say that if we saw something happening that we wouldn't be incorporating it. If we could see on the horizon that there was a blip coming, and often you can see it.
I've heard some rumblings. People talking.
Isn't the issue there that the real question is the economy of the greater area?
Yes, exactly.
And while one of those sectors may have some impact, something else will step in its place. So it's the underlying labor pool or skill sets. So
Right.
I'd be more worried about housing costs if you want to raise a regional concern.
Yes,
Alan, and then I
Okay.
think we should move
right.
on.
Yes.
I know it sounds like you're going to go through the housing in more
Yes,
detail,
yeah.
so I had a quick question about the hotel.
Yep.
Looking at the older plans of the hotel, there are 28 units on a floor. And if we're in this negotiation about the scale of the hotel, and a select service hotel is functional between 175 and 225 units, eliminating a floor, it puts us at 175 rooms and slightly fewer parking spaces also. So what does that mean? Does that, because the cost of the project is less, their revenue's less, but how does that factor? Is that a point of negotiation because it's still within the acceptable scale of this program type, or?
Yeah, what I would tell you is that the hotel returns are at the low end of the spectrum. They're not below market as the residential ones are, as we'll get to in a minute, but they're sort of at the low end of market. Now, when you eliminate revenue producing space, you also eliminate cost. But there's always, you're theoretically at least generating more revenue than you need to support costs. So when you eliminate revenue, you're going to get a disproportionate effect on things like fixed costs that then have to be amortized over a smaller number of revenue producing units, like the land, like architecture. There are a variety of things that are not scalable in that cost pro forma. Now, how much influence there would be if you eliminated a floor it's a little hard to calibrate the exact impact, just because there might be things that you could do within the envelope, to curtail cost impact. There are things that you could probably do to try to mitigate some of that effect. You might, and I'm not suggesting this, but you might consider things like, especially with the cost of parking, for example, that those costs are especially high, right, on a relative basis per space. So there might be some
like a lower parking ratio.
Yeah, there could be some trade-offs there, that you lose a little on the one hand, but you might gain a lot on another. And so I think my suggestion to you would be that you you negotiate around what works for a hotel, a feasible hotel of an acceptable, marketable size, and that the impact of that be measured in terms of how much better it is on a design front, and if there are questions relative to the feasibility of it post facto, post change, that we look at the details of that. Again, hotels are a little more difficult than a multifamily to sort of be in an off-the-cuff way say, hey, no problem. Let's chop those units.
Yeah.
Chop those units out of there. But
It was good.
But
was good.
it's sort of a good segue though into this next question that was asked about. Well, do you have to do them both? Do they cross-subsidize? How does that work? Can you shift more of the land cost, for example, out of the resi bucket over onto the hotel bucket as a way of helping the resi to be more feasible, more doable, and ultimately smaller? And what I would tell you is that the pro formas that I've seen already do that. They already shift roughly 60% of land cost over onto the hotel side. That's frankly one of the reasons why the hotel, doesn't perform sort of in the middle of the range. It performs at the bottom of the range because it's bearing some cost that might otherwise have been apportioned differently. And so so there is some cross-subsidization already of that sort baked into the pro formas that I'm looking at. I guess the only other point I would make is that because the hotel returns are at the low end of sort of acceptable, I don't think there's a lot of room there to push a bunch of other stuff over in a cost-sharing sense. And I guess I would also simply say that for this project to be feasible, financeable, these two things have to stand on their own as independently underwritable. I don't believe these are buildings that can be cross-collateralized. It's a different kind of investor that wants that hotel as opposed to the multifamily. That doesn't mean at the developer level that there isn't some benefit of having the two of them together, ergo the sharing or disproportionate distribution of the land cost, as an example. But it's not the kind of thing where, Kara asked me at one point, well, let's put condos on top of the hotel. And a few condos over here, and it's like, no, Kara, we can't commingle the asset on the hotel side without really hampering the financeability of it. Even if on paper, we could pencil, condo units would sell for a lot more and contribute a lot to a bottom line. Well, yeah, but if nobody will do it, it hardly matters. And if nobody will finance it, it hardly matters. And I think that there programmatically, I think you want, for feasibility to be preserved, you want to have independently financeable entities on each of the two sites. It's just, I just think it's a mistake from a fundamental feasibility point of view to try to do it the other way.
But if you look at the Ritz or the Mandarin or
Yes,
all
the
those,
Ritz
is
or the
it because
Mandarin.
there's so many condos?
No, it's
that
because
makes a
it's the
difference?
Ritz and the Mandarin.
Oh, okay.
You don't get synergy if it's the Hilton Garden Inn.
What do you mean, the synergy between the hotel
It's the
and?
quality of the
Resi units.
hotel.
Yeah,
the
the
quality.
services
And
that you can get.
Very high.
that layer caking approach really works with only certain brands. It does not work with we'll call it the middle market select service branding. It just is not it creates more problem than it solves. The reason that people do it, like at the Mandarin and at the Ritz, and there are several others that are ongoing, that are going to come to market. The reason you do it is because you get premium value in the upper floors because you affiliate the branding of the hotel with the residences. We just did the study, or not just did, several years ago, did the studies for Dick Friedman at the Four Seasons with One Dalton. And the premium value that translates to upper floor units above a Four Seasons hotel is tremendous. That project, those condo units are going to sell for $3,500 a foot on average. And they're more than that at the top of the building. And 25% of that value has to do with the Four Seasons in the base and what that means about the customer who will come.
I mean,
So-
you should add that that's double, maybe more than double what the current average per square foot selling price is for Boston.
Absolutely.
I mean, this is New York and beyond.
Yeah, 1,500
Exactly.
square feet is about where we are on average, even in the luxury stock. Luxury
So
stock.
in
And they're
terms
getting
of
it.
that
And they're getting it.
example though, I'm wondering, obviously Brookline is never gonna command anything like that. But I mean, we still are talking Coolidge Corner, extremely desirable. Okay, I mean, in terms of the structure from a legal standpoint and how you divide up the hotel versus the condo, the condominium, and how it all works together and so forth. And it doesn't seem to me to be a barrier for
It is-
different
It's a barrier
investors to
because you
for
can't
financing it.
attract the Ritz-Carlton to Coolidge Corner.
No, I'm not saying that we could, but I am saying that we could have potentially, depending on what flag is brought here, something that is hipper than the Ritz or something that would still nonetheless command a premium price. I mean, ridiculously small condos in Coolidge Corner are already going for $2 million plus on the order.
Yeah, I
So-
guess all I'm suggesting is that it's the commingling of hotel with resi that's at issue. And the viability of resi on top is enabled by the brand of the hotel down below. And if you cannot deliver a brand down below that can confer a premium, then the economics of it don't work. And so it's, you don't lead with, oh my gosh, Brookline can get good condo prices. You lead with, can we attract the hotel that's necessary in order for that scenario to work? And in my opinion, it's not the right location. It's not the right market.
Is this because it adds costs for the residential unit that you wouldn't otherwise
Yeah,
have?
that's what
That
I'm
has to be made up by
Separate
the demand?
elevator core. I mean, there's a whole bunch of cost ramifications that come along with that layer cake approach, which, you have to deliver a premium in order to defray the cost of those premium costs. So it's why it's just not done. We're going to see a big hotel condo development go up on Trinity Place, because it's got a European, brand new European brand that's gonna come in. Those are going to work well. And there are projects in the Seaport that are under consideration now that will have the kind of hotel in the base that are needed, but you must have that hotel in order for that concept to work. Again, that layer cake
Yeah, and you don't
concept
think
to
the
work.
Coolidge Corner Market
No.
is anywhere near
Nope.
able to attract something
Can
like
we
that?
move on to the residential? Or-
Yes, let's talk resi. There were some questions about the tax law. I've given a little summary of it. I'm not gonna spend a lot of time on it. You can look at it, because I do want to talk about residential. The base case that we've examined, as you probably know, it's 134 rental units. I think many months ago, there might have been condos somewhere around, but those have been gone for a long time. Just to be clear, the condo concept has not been in place now since early 2017. So Kara said to me at one point, what about, let's just put more condos, as I mentioned, and, that's just not a part of the current proposal. It's a rental proposal, 15% affordable, in 14 stories, 13 plus a penthouse. The penthouse is smaller. Again, 203 hotel rooms in a 9-story building with 152 spaces below ground. That's the basic program that we've been looking at. In the affordability, 10% of it is targeted to 80% AMI, 5% of it to 100%. I think there's a two-thirds has to be at 80% or less, and so it follows that model. The land, the cost has various components, which I've evaluated. The base case, the base pro forma, developer pro forma, essentially follows the assessments. That's the fundamental assumption, which happened to be a little higher than what they paid. It's more than what they paid for the property in whole. And as I mentioned, most of the land cost is pushed over onto the hotel side of things. Only 40% is on the apartment side. And, I do a lot of land valuation work for hotel and for residential projects. And the assessments and, by extension, what they paid, which is a little bit less, are far below market, I'll just say, in terms of what cash on the barrelhead would be for a site today. So the metric that is present on the apartment side is about $30 an FAR foot. Okay, that's, in the vernacular, that's wicked low.
You could just compare that quickly to the gas station site at River Road. It was a little over $300 a square foot of land. So we're talking apples and oranges. I think the square foot of land here is around $270.
And you're saying they paid $30?
They paid a little less than that. They paid about 5% less than the assessments.
There's some wild variations in that. There's 3 sites, and so they paid a lot for a site that has an assessed value that's less, and then years ago they bought a site that has an assessed value that's way up. So that's
So if you blend
it's a blended number, but
blended, it's it's the assessments are a little over 14.5 mil. What they paid is around 13.5.
Sergio?
Pam, could you just clarify one thing? In the statement about the disproportionality of the allocation, is that based independent of the footprint of the buildings themselves? In other words, the hotel actually occupies a larger portion of the site. So I was just trying to understand.
Yeah, that's a good question. I didn't calculate that, but we could look and see whether or not. I mean, all I've done is I've said, okay, what percent of the land cost is being borne by apartments versus what percent is being borne by by hotel, and then looking at that per square foot metric to see whether or not it's above or below where we would expect to see.
We all know that the footprint of the residential is actually fairly
Yes.
small
Yes.
compared to the footprint of.
Right.
That's why.
So
I'm
on a
asking.
land foot basis, it may not be as much of a disproportionate allocation. That's entirely possible.
Thank you.
I could calculate that. Hard cost, it's at the low end of a market range for cost at a little under $340 a foot, which excludes the parking. The underground parking works out at about $85,000 per space, which I think is probably light, just judging from what I see for underground garage construction. But in the analysis, I've not tried to say, hey, it should be $375 a foot, and we should be carrying $100,000 a space. The analysis is predicated on what we're seeing in the pro forma. Again, so long as they look like they're in the right market realm. Soft costs 13 to 18% of 13% of total, 18% of hard costs. That's, again, pretty conservative. We usually use 25% would not be uncommon. Contingencies are in at 5%. That's what an underwriter would use. The revenues are forecast between $3,100 and $7,500 per month for apartments. That's for market rate units. It works out to about $450 to going to $475 a foot on average. It's in that band
Per month.
per month. With the affordables, as I mentioned, 10% at 80% of AMI. That's a little under a $1,400 a month rent. 5% at 100% AMI, which is a little under $2,000 a month in rent. The finance is in the market realm, 70% loan to cost, and those metrics filtering down produce a 5% return on cost for the apartments and a 7% return on cost for the hotel. Apartments, the optimal is 6%. The acceptable is 5.75-ish. 5.5 is the absolute minimum. And 7% on the hotel. Again, optimal is 8. Acceptable, we'll call it, is around a 7.5. And the minimum is around a 7. So we see the hotel kind of there, and we say, well, in spite of its being at the low end of the range, hotel investors are of a different sort. We think that's not crazy. A 5% return on cost for an apartment is very, very low. And I've been through several financings recently and literally had people say 0.1, not doing the deal, below threshold. Now, I think it's, it used to be that you would say, if you can't get to a 6, forget about it. It's not doable. And I think as costs have continued to creep faster than rents, and as the demand for apartments continues to completely outstrip supply, developers know that they cannot build a building for a 6. You can decide that you want to have a 6% return because that's the gold standard, that's what you're used to. But if you actually want to build a building, you've got to accept a 5.75. And so we're seeing developers go to that lower bound. Whereas even a year ago, 18 months ago, they would have said, no way, Jose. And so I think if you're in the business and you want to build, then people are accepting some things that they are uncomfortable with, but they're doing it because that's what you have to do to be in the business. To go to a 5, however, is beyond the pale, in my opinion. That's a well below market return.
Does that mean you have to put more equity in?
It means that you have to put more equity in and get less return on that equity. So it's a twofer. It's not just that.
And what is the time frame over which you're thinking about that return on equity?
Well, I mean, I think what I would say is that we have, if we have someone who's got a longer term view than
Right.
the norm, and I think that obviously they're not going to do something that is completely
Right.
crazy, and so that attribute of having a longer term view is what's at play here. Meaning that if you were to go to the marketplace for the typical investor, even with institutional money that might have some patience, that's still a 5 to 7 year proposition at the outside.
Mhm.
Really it's 3 to 5. It's stabilization and we're out is the norm.
Mm-hmm.
So I think that when we see these returns and we say, well, what the heck? You have to ask yourself what motivates, what's at work here that is different than you might otherwise see in the marketplace. And I think that that's the only explanation. I mean, I think the proponent here could, I'm sure, answer direct questions on that point. But that's the only thing that I can see. And we have, as you'll see sort of towards the end here, done some sensitizing of those returns to certain moves in the pro forma. For example, what happens if we drop for example, I think the question was asked directly, what happens if we ratchet the land number down to what they paid as opposed to what it's being assessed for? What if we put it in as a bogey? What if we say, hey, it's a zero? How much do these sorts of things move the needle? And I don't know if you want to just jump to that before we talk 40B, but I think if you look at the very last page of this, it's worth just looking at. That scenario 1, if we assume that 40% of value is sort of the way to apportion between the hotel and the apartment, we have a 5% return on the assessed value. That's in the base case. If we drop it down a little to the price paid, the return goes up to a 5.1. And if we zero out the land cost entirely, we go to a 5.4. So,
What about the rents being kind of low?
well, on a 12-story building with the sort of unit mix we're talking about here, I think, to get $475 a foot on the market site, that's pretty good. Now, if you were in a 20-story tower with a view of the water downtown, you'd be at $550. Right? So, I think there's, and we'll come to it at the end here, there are ways to envision trying to improve the revenue side, to your point. One of them is to shrink the units, or some number of them, because the price per foot is derivative of size, unit size. And the programmatic objective of this pro forma is clearly to target an empty nester market, a market that is expecting a 2-bed unit. And not expecting many studios. There are some studios in the mix, but not many. And so there could be some approach here that tries to downsize some number of units. I think that I'm persuaded, I guess, that the market is there to accept an empty nester product in this location with the walkability and so on. But that price per unit for a 1,500 square foot or a 1,300 square foot unit is a different price per foot than you'd get if you were at a 500 square foot
Right.
unit. So, I mean, again, I'm not suggesting at all that, that you would go hard to downsize everything, but there might be some nibbling around the edges on the mix front that could deliver some kind of improvement to mass and height. I think that's a direction you might think about. Yeah.
Oh, Alan.
Alan and Lindsay.
My question was exactly about that. Like in this plan here, there's on one end there are a couple of the residential building. There are a couple 3-bedroom units on the end, which could be replaced with 2 1s and 2 studios, or 2 2-bedrooms and a studio. And if you multiply that by 10 floors, we could go 12 floors, and you could get the same number of units on one fewer floor. But I don't know how the profitability of that, stacks up.
Yeah, I mean, it's clear that price per foot is improved. Expenses per unit, not as much. That's not as scalable as you might imagine. There's also just you'd have to determine whether the count that you end up with creates an unintended parking ratio issue. So there's but there's a
See the box?
We control that.
No, actually, we don't, the marketplace.
you don't really, but I think that's again, what I'm suggesting, I guess, is that there could be some tweaks to the program. The only thing I would say, the only caution, or just as you might think about how to push on that point, is that you want to make sure that you have a mix in the building that actually works. So meaning that if you think you're going to do Animal House on some floors and uber luxury empty nesters on other floors, you're going to have to make a balance here of the demography, if you will, so that you have a compatible
It's a party walls before.
a compatible mix in the building, and importantly, a compatible set of amenities. I mean, there are ramifications as you start to push and pull on these various fronts. And again, that doesn't mean that there might not be a way to tweak and change some number of units, a stack or 2 perhaps. There's also that issue, is just the efficiency of design. You've got to stack units of a similar kind above one another. Otherwise, you create additional cost and efficiency in the building. So you can't willy-nilly kind of mix and match one kind of unit on one floor and think that you can just put bigger units or smaller units on the next floor. They all have to line up design-wise. I just came from a design meeting where we were just trying to get a few larger penthouse units in a project, and the architects were going absolutely crazy. You can't do that. The pipe chases, the ducts don't line up. But anyway, all I'm suggesting is it's a direction to go carefully, and with thoughtfulness to how it actually works, both from a community point of view and from a cost point of view.
Ken, then Susan.
Yeah, since we're dealing with a tight pro forma, and we're getting perhaps down into the weeds a little bit, but
Yeah.
since every 10 basis points counts,
Yes,
I guess we
yes.
can have that discussion.
Yeah.
Just a clarification on your summary here, the 152 parking spaces on page 2,
Yeah.
2A. Maybe I have an older version of this, but I thought the apartment building had allocated 148 spaces. So is the 152 just for the apartment, or? just for the apartment? Okay.
That, yeah, that's
Getting
just,
marked
that's just
in.
for the apartment. I'm
Okay, so I had
sorry.
140, so that's,
152.
so that gets us to then
And it's-
the ratio of over
Right.
1.1 or
But that's
something.
including the 20 for the next door neighbors.
Right.
So in the 100 and,
Yeah, I was thinking, because we had 227 last year.
Yeah.
it's what, 230, 232?
232, I think.
Right,
in the
Right, okay, so I had, yeah, I had run,
Yeah.
I had 148, but I
Yeah.
had put 12, I had put 12 of those in the residential, and then 134 in the, okay, anyways, so, and then,
Well, included in that is 25 for the abutters.
Oh,
Right.
no, I
that's
split the,
25.
when I was doing my numbers, I split the abutters number half to the, I allocated half to the hotel, half to the residential anyways. So, but the ratio for the apartments is a 1.0, okay.
The one.
And, just to clarify that.
Yep.
And then, the operating costs, and the vacancy factors,
5% vacancy.
5%, okay, that's a little higher than I would have guessed. But, what about the operating costs?
Year one is around 15 grand per unit. Again, that's luxury. That's a luxury metric.
Okay. And,
Includes taxes and,
right, and then for the retail, there's only a small component of retail, what about
Tiny.
4,200?
yeah, 3,500.
Oh, it's
Yeah,
reduced to-
it's not much.
Okay,
And,
and,
you know, I'm not remembering the rent off the top of my head. Actually, I've got that here somewhere. I could-
but that should be additive to
I
the,
think
It
that-
is,
I
it's
think
in
that
there.
came out. I don't think there's any retail in the latest,
Let me
None
just,
at all?
none.
none.
I had an old version that had 4,257, which I think included some space that may or may not have been community room.
It was somewhere between 3 and 4,000 of retail at one time, but that's now taken up by amenity space and the resi started.
We eliminated the mezzanine.
So there's no retail revenue.
Correct.
Okay. So that's another difference in.
Yeah, there's actually in the pro forma I have, there's some retail income.
Do you? How
Yep.
much? How much?
$244,000 stabilized year one. Plus parking income, you know, of course.
Susie?
So Pam, before we get to the 40B discussion.
Yes.
This was a topic we touched on at our last meeting, was some kind of analysis of hotel only. Everybody seems to like that, you know, the hotel concept in this location, where it's being built. Either the hotel as proposed and have that be the only project that's there, at least for now, versus a somewhat larger hotel, although I understand the sweet spot for this particular kind of hotel, if they are where they are. So it would need to be either a different kind of hotel, but the suggestion is that something like that wouldn't work.
You know, I think as you get over 200 rooms, you start to depart the select service route. It's just not, it's not, again, not to say that it couldn't be 205 or 10, but if we're thinking 250 or 300, we have to have major meeting room, group business going on. It becomes a very different kind of animal. And that, frankly, you know, that kind of hotel, that full service meeting, group business driven hotel, is A, going out of favor, generally speaking, in terms of what developers are building. And B, I'm not sure that Coolidge Corner can really be a function hotel.
So,
You know, I'm not sure that that's really what you would want, but that's kind of an ancillary, comes along as an ancillary part of a program once you get into that size realm.
and so did you analyze the cost of doing a hotel that's maybe slightly larger than not the full
No,
service?
I did
like
not
you're gonna-
analyze hotel
Oh,
only
okay.
scenario. I did look at 40B, which of course is the alternative, which is the reverse, which is a
Housing.
entirely a housing scenario.
So why don't we just talk about that briefly?
Yes, briefly. 40B, the program that has, as I understand it, there's an application out there, 299 rental apartments, of which 20% are affordable at 50% of AMI, in a 12-story building with 333 parking spaces. That's the program. The land cost is in at the 40B cost. Under 40B, one of the requirements under 40B when you are presenting a pro forma is you can't have a land value in there that is big because you're going to get the 40B, right?
Right.
You have to have a land value that is reflective of essentially of a by right zoning envelope. So the number is in here of that 40B standard based on a 1.78 blended FAR across the site and the market land value that would be achievable for that smaller program. And that number is fully 25% below the assessment, is fully 25% below what was paid, or 28%, 28% below the assessment, 23% below what was paid. So just so you know, that land cost basis is in there at a low rate. Hard cost numbers are a little higher in this pro forma. Even excluding the underground garage. Soft costs, they're closer, I guess, is the point to market. 375 is where we would typically see steel construction. Soft costs 15 to 19, that's in the right ballpark. Contingencies 5%, that's okay. The market rates per unit per month are roughly the same as what we're seeing per unit per month in the other scenario. The composition of it is slightly different. Some more smaller units, some more larger units, delivering a slightly lower, slightly higher range. The affordability is again 20% at 50% of AMI. That's a little over $1,000 a month in rent. The finance is assumed at a somewhat higher ratio of value, 75% mixed finance on cost, and it includes a combination of conventional finance and tax-exempt bond finance. So there is an element of, we'll call it financing that's unique to the affordability realm here that is baked into this proposal, which is not in the other proposal. The returns on this work out at about a 5.3, which I guess what I would say is, that's approaching feasibility. There are things you could do probably in this pro forma to get you into the 5.5 realm. Looking at things like, that hard cost number, for example. You might be able to tweak that some. I think what I would say about the 40B program proposal is there's probably room in here to shrink the size of this and have it still be workable by manipulating some of the variables here. I think unlike the as proposed scenario where we're just way out of the market realm, this is close enough. And I think there are things that you could do to push and prod this up to probably be a little smaller than 299 units. How much headway you can make, I don't think you can cut it in half. It's not like that kind of a reduction. But I think there's
Why
probably...
is that?
Just because if we know that if we reduce the size of it, we're going to lose the economy of scale that is making the 5.5-ish rate of return possible. And if we impair that economy to too much of a degree, we're going to fall back into the territory of infeasible, just like we have on the other side. Now, how much smaller it could get, again, I think is on a 40B proposition. We could do some more work to try to determine, how much smaller it might be able to be if you were to push and prod some of these variables. Again, I'm looking in particular at that hard cost number. I don't think you go much further. You don't go lower on land. I think that's already kind of where it should be. I don't think you go too much further in terms of the percentage on cost for soft costs, but there may be some things that you could do on the hard cost front, I think. I mean, we know that 340 is doable on the other one. Why not something
The
closer to
economic
that here?
impact on the town of the hotel residential proposal is
Well,
significantly.
Yeah, I mean, we're not accounting for that anywhere
Right.
in that. So, I mean, I think, again, that's just a fact of life. If you go in the direction of 40B, is you lose that in its.
Just to put some numbers next to that, the Marriott Hotel, if you include the excise tax, it generates about $14.50 a square foot.
There you go.
The new Marion Street 40B generates $5.20 a square foot. So it's about 275% higher tax revenue. That's the structural components. That's the commercial tax rate, 170%, the 6% excise tax, and the fact that the 40B has a 20% affordable component as opposed to 15% in inclusionary zoning.
And keep in mind that we've just committed to probably about $200 million of school building costs for the Driscoll plus the Baldwin proposal, if that goes ahead.
The marijuana is a bit of code?
I don't think so.
Can you remind us what the maximum return as far as 40B is allowed?
Well, you still have to be able to service the debt. You still have to be able to draw the equity to the project. So you're still in that 6% realm. You've got to get to those metrics in order for even for it to be viable. Remember, it's only 20%. Is on the affordable side, and yes, the tax-exempt bonds help you to some extent, but the capital stack is largely made up of a conventional loan with conventional equity needing conventional returns.
And
So-
that's 20% at 50% area of median income as opposed to the inclusionary, which
Which is
is
80% for
well,
fif-
for
10%.
10%, yeah. So
5%.
2/3 are at 80%, and that's a meaningful
It's not
distinction.
nothing. Yeah, that's right.
Why are the hard costs higher for the 40B?
You know,
Well, there's a heck of a lot of parking.
No,
there's
it's not on the
That doesn't
parking,
include it.
it's on the building. And so for 40B, you don't develop the drawings to the same extent. So this is based on conceptual plans given to the same contractor. They're going to be conservative, not knowing the details. We've gotten much further along here, and so we've gotten pricing, and in fact, each step of the way, it's been a balance between them understanding it better and the price inflation that goes along. This last time, the pricing was pretty steady with the last pro forma that we ran, I don't know, 6 months ago, despite the increases in prices, because now they know with more certainty what we're talking about.
So in the end, it wouldn't be more.
No, I don't think so. No, there's no reason for it to be more.
right. Yeah, so I mean that could have a material impact, obviously, on the way that those returns look at the end of the day, and therefore on how much of it you have to have in order to deliver a reasonable return.
I truly didn't understand about the land costs, I have to admit. I mean, just how can you assume less than was actually paid for it.
Because that's the rule. You go through a process, they hire the appraiser goes out, you have to do a by right value, according to by right zoning.
Do you remember that chart we had that showed the, because there's different zonings for parts of the site.
Right.
So the FAR was slightly different, but anyways, so if you took that as your cap, I don't even know if you could assume the bonus,
Yeah, I don't think so.
Yeah.
I think,
which is fairly easy to achieve, but still.
yeah, but I don't think you can. So,
You mean the public benefits?
Public benefits bonus, thank you.
yeah.
What's kind of interesting about that though
Here's
is that
the-
it shows what the value
here's the
of the
chart.
upzoning is.
Oh, that's interesting.
If the land cost is so low for what the by right is, it's by granting an upzoning, we're giving a huge value.
Well-
It depends on the returns.
Yeah, yeah.
If you don't put it into the pro forma and you put it below it, and it's getting
It's the
5%,
opposite.
right?
You have a low
Right.
land cost and you have a low return. Imagine what the return would be if you had a high land cost.
Right, exactly.
Uh-huh.
Right. If you plug that higher land number in there, the returns go down, they don't go up.
Sergio?
I just had one follow-up question. Somebody, I think, asked the issue of why the parking under the 40B was not a significant cost component. Could you just help us understand that? Because you would think that it would be.
Oh, it is.
Oh, it is.
Oh, it
It's-
is.
It's very
Yeah.
substantial.
I mean, I'm getting a lot of numbers, but
Yeah,
$28 million
yeah,
just for the parking. 85,000 a space?
Yep.
Yeah.
yeah.
So does that include the 25 for the neighbors
The
again?
numbers came out at 75.
It's 75 on the 40B.
Well, because 40, some of them was about, some of the spaces were above
Above
grade.
grade.
If that- I'm looking at the old one that was
Yeah, oh,
dated
Yeah.
in March of 2017. You had 41 spaces above grade.
Right.
What's the status of those 25? Are they going to be deeded to the individual condo owners? Are they going to be leased? Are they going to rent it on a monthly basis?
The promise that I made is that they'd have pay the same rent that one of the residents would be paying, and they'd have the right to it, so when they sell their condo, the new
God,
person
they
would be
make
able to rent a space at the same value as our
I
residents.
don't see why that should be a public cost. I'm sorry, I don't.
How was it?
Because we have to have a certain size building, it has to be, blah, 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 to make all this pencil out, because we're including the cost of those 25 spaces.
It's a subsidy for sure.
It's a subsidy to those individuals who are gonna have that
You
benefit.
use the term public cost, I'm just.
Well, yeah, it's a public cost to have a shadow that's that much bigger, that much more traffic.
That's on them.
Those are public costs.
Right, well, they're public impacts.
Yeah.
But you might, I just want to be clear, you're not saying that the town's paying for that in terms of.
No, but I think the community is. I mean, it's,
It increases the impact.
Yes.
I'm not disagreeing with it.
Yes.
But it doesn't.
Susie, and then we'll see if we can wrap up.
So I'm still on this hotel question, which
Yes.
also came up when we spoke the last time we were together, which was, so I asked my question about one hotel only. There are some locations, including a client who's doing this, where their proposal is actually going to be 2 hotels, different types of hotels. Kind of select service, but then maybe an extended stay, people who are here for work for extended periods, that kind of thing. What about that idea?
That's a model that we see. I mean, that's not a new idea. That's something that that hotel developers are doing, where you're trying to optimize, quite frankly, development envelope on a site where, you don't have another alternative. It tends to be more complicated operationally, marketing-wise, just because you've got to mount efforts in both directions. They can't be the same. They've got to be. Usually, it's an extended stay, as you're suggesting with select service. That's That's the combo that we see most often. It's an interesting idea. I haven't looked at it. I wouldn't want to comment much more than to say that I've seen that model before.
It might be worth thinking about. It's something that.
I don't know, do we want that many hotel rooms on the site?
If
I
it
don't know.
could be.
Well, the developer will
If it
not,
could-
the developer would not
What
accept.
business is the
the
developer
low-
in?
low
Right.
The
return.
housing
Yeah.
business, and they own the site.
Yeah.
Yeah.
Yeah, so
I'm
it's
sorry?
not gonna happen.
We don't, the developer owns the site, they're in the housing business, and if they don't
I
want to
realize
consider
that.
it, why
No,
not?
I
So there's no
understand.
So
point
it's
in
not
us
gonna
considering
happen,
it.
so it's that simple. And if you want to start asking why I'm doing the returns that you're doing that no one else would do, I can get into that at some point.
So,
Sorry, just one more
Linda,
question.
yes.
Well, I'm just noticing on the handouts from Pam that we have some scenarios that we haven't talked about.
Right.
Yeah.
So we haven't talked about the
Yes.
smaller building on either of the 40B or the other.
Yes, so that's right, we haven't.
Yeah.
So I did do some, as I said, noodling around what might move the needle. And, land doesn't do it. I tested that. Land just doesn't do it. One of the reasons that the returns are the way that they are is because you've got affordability here, which is causing the building to need to be the size that it is in order to cover that internal subsidy, you call it. And so I did test what would happen if you were to move affordability off that site, and how much of a reduction might that move create. Again, I'm an agnostic on whether that's a good idea or to what extent it should be all or some, but it's clear that if you were able to improve the revenue stream from those units, and even with, and I suppose in the bargain, reduce cost by shrinking the building down to by a story or two. I mean, again, if you moved all the units off-site, you might actually get two floors out of it. You can get yourself into that 5.5% return territory with that kind of a move. And so, again, it's a directional suggestion, not a prescription by any means. And there are probably other things that could be done from a design point of view, just to think about, is there a way to push or pull the massing of the site to get more units per floor? Again, in addition, and I didn't put it down here, but the one that was mentioned was this idea of fiddling with mix, and whether or not there might be some way to tweak the mix to get some more higher revenue producing units into the program. So again, the idea here is to provide some suggestions directionally about what else you might do in a conversation about this. Clearly, it's not rocket science. Anything that improves the revenue, that reduces the cost, or reduces the operating expense, all inure to that bottom line. And there are things that can be done within the confines of a rental apartment program and a hotel program that I think are workable. But I think that those are worth talking about.
Alan or Sergio?
How much leeway do we have on the hotel parking ratio? Like, to give the example of the Brookline Avenue Hotel, they ended up building it, or the permitted version had fewer spaces than what we had discussed in the meetings in that committee. Is there any leeway for the hotel in adjusting that?
Well, I think parking ratios is a hot topic. We're seeing underwriters requiring for hotels somewhere between a 0.3 and a 0.5 per room metric. Now, if you're transit accessible, you're in the middle of the market that you're serving, you can get down into that 0.3 territory. You have to be very urban to get there. again, at the top of that range at a 0.5, is sort of
For the hotel you're talking
for the hotel.
So what
about.
is
We
the
are at
assumed?
We are at 0.35.
Yeah, 0.35. So I mean, I think that's the band. You've got to be in an urban location in order to get down into those numbers. To go to a 2 or to go with no parking for hotel is not an option. You've got to be somewhere in that 0.3 to 0.5 realm.
Even though the hotel on Brookline Ave is less than 0.3. Well, it was 0.25 or something. 0.27.
0.27 is what is
Yeah.
that one space?
Alright, point taken.
What about for the residential though?
Well, I mean, I think that this idea of tweaking mix and thinking about who your market is something, that would go along with the the parking requirement that goes along with that tweak is something that you have to link. If you're appealing to an empty nester market, you must have, guess what? One. You must have it. It's not an option. It's not a matter of, oh gee, someday it's going to be condo. It's because that renter is coming out of a house and they have, frankly, at least one car and maybe 2. And so what you're trying to do with the mix is orient the program in a way that allows you to provide 2 when you need it and to provide less than 1 where you don't. And so, I think the market requirement, again, for millennial studios is like a 0.5.
0.5 parking ratio.
Yeah, could be as low as
Could be nothing.
or, well, I mean, if it's like 300 square foot, live work
The micro
stuff,
units.
micro
Just-
units,
Yeah.
it could be.
Maybe they could live in the parking lot.
Yeah.
I guess the
It's as big as the
point is
unit.
that you do, when we do the marketability studies for these things, we look at units. And we say, okay, that unit, we need 2 for that. That unit, oh, we need 1. This unit, 0. And then you look at the blend that you end up with. And usually the blend works out to, something higher than a 0.5 and, up to a 1. But, I think it makes a difference, I guess, is simply the point, what the mix is, and as to what you end up with for a parking ratio.
Sergio.
I would appreciate a little bit more education on the off-site affordable option from 2 perspectives. The first is, isn't there a set of costs that are associated with that which are not presently reflected in the 5.5 return? And so isn't that in fact a kind of an artificial?
It is to some extent. I guess the idea with offsite is that you're trading revenue in one place for revenue in another place. So you're not having to construct it if it exists somewhere already. There is a differential if you have a property that is priced the same way that this one would be at top of market. But presumably, the benefit of moving units off-site is that you are trading lesser units, less
revenue producing.
producing
Yeah.
units, and hopefully you end up with some kind of equivalency.
But when
Or
Now-
maybe not that much in fact, if there are other units that aren't generating the kind of revenue that you could generate here and
Well, I mean,
you're
I
getting
think,
something here.
it's a little bit difficult to think about this in the hypothetical, right? Because it matters very much what the offsite is. And you're not wrong, Sergio. I've waved a wand over it with my my consulting wand, and I've said we're going to pretend that there's equivalency here, and that we're going to be able to get essentially the.
Now, of course, one option is a contribution to our Affordable Housing Trust Fund.
Well, so that was the other part of this question, which I just wanted to understand. You mentioned in trying to respond to me the possibility that there may be some existing affordable housing. And is that in fact a legitimate interpretation of what we're asking, that I thought in general we were looking to have a net increase, and therefore simply, I don't know what the right word is, repurposing what's already there may not.
It certainly wouldn't
Yeah,
help
why
our
would
40B.
Well, but if you
No, no,
have
why?
units
I
that
don't like
aren't
it
restricted,
philosophically.
If they're
I really
not-
don't like it philosophically.
if you,
I mean,
I
that's
don't
the
like
issue.
it that way.
if you have
really
don't. Yeah.
units that are unrestricted that become restricted,
Ah,
you see,
So-
that's,
Yeah,
So-
that
that's,
would,
that's
that
what,
would
that's
then
what,
you're
making
that's what I'm
it-
talking, that's
Is
what I'm
this
talking
So-
about.
gonna be like a zoning change or something to make this?
no.
No,
Well, then it wouldn't be about,
So,
you know,
Roger.
they needed to go back to by right.
So I can report on this from the Housing Advisory Board. We took this subject up at some length. And it wasn't triggered by the favorable economics, but more by trying to answer a question, is there a way to reduce the mass and the, height, whatever, of the building from inclusionary zoning on-site versus moving units off-site. We discussed this at two levels, really. One was a specific proposal where the developer would I think it was just mentioned, make some off-site existing units presently market rate into affordables. And so we looked at that specific opportunity or prospect, but then we also discussed it partly because of, I think, what Linda just said, from a policy standpoint, what the town, or not that the HAB speaks for the town, but at least it's a starting point for these discussions. And there was an outcome, and it was a consensus of the whole board that was present for the discussion, and it was that the specific proposal was not something that the HAB felt was attractive in terms of the quality of the units relative to the new. But we didn't end up just rejecting the whole concept, and I think Pam worded it here with a little more latitude for different approaches. And what the HAB came back with was, in responding, was for a project of this size with new units in this location, that there should be at least some affordables on site. And I think you're correct. There was the opportunity with the 15% is approximately, translates into approximately 2 stories of height, roughly. And the HAB felt that at least one of those stories should remain on-site affordable. So half of the 15%, or roughly whatever that turns out to be. And that going off-site for the rest wasn't as attractive, but that we should, and maybe with a little bit of help, but there's a calculation, the financial equivalent, and we weren't looking to raise the return to the developer. In fact, I'm not sure the town would be looking at that as the motivation. That there would be a figure that could go to the Housing Trust Fund, which has a record of producing, leveraging more affordable housing through a different sponsor at a different
So,
location.
Split the baby, so to speak.
Can I ask what the rationale was from the board in terms of that consensus of the first proposal? Why did they think that it was so important to have affordable units at this particular project?
There's a general sense that in the larger projects, and even the inclusionary zoning itself, if you're familiar with it, it allows more flexibility for smaller projects, either the trust fund or offsite. But on the larger projects, I think there's some philosophical view in town. People can agree or disagree that if there's that quality of housing and that scale, and that there should be some affordable.
Just like that, without, even though that might have other town impacts, just,
Yeah,
I guess that's.
it was
Well, not
I think it was
arbitrarily.
a sense of town meeting, and I think it continues to be a sense of town meeting, and it was that was part of the whole Hancock Village
No, I
discussion.
know, that's why I'm asking, because
But-
again, we have a situation where the impact is mostly felt on this neighborhood, but
Well,
I
but
guess
that's why
the-
the HAB, it wasn't an arbitrary black and white. The HAB did come back and try to think about this and said, we can see reducing some of this and leaving at least something on site, but taking a contribution and finding other creative ways to do the
Okay,
rest.
well,
So it's
I
a
hear you.
give and take.
Elton.
I think last year you were talking to us about podium and roof frame above, and I think there was generally a maximum of 2 + 6 or 8 stories. But I
So-
know that recently taller buildings have been built or are being built in America, and we have a 9-story hotel here. So I'm just wondering if you think there's any interest in exploring the possibility of that, if from a cost point of view.
We could certainly model a stick-over podium alternative. I think that the character of it is obviously quite different. I mean, it's not going to be it's going to be a wood frame building. And so, I think that in some ways that's between you and the developer. The developer will either find a stick over podium product, addition to that from his portfolio acceptable, but from a design point of view, you're going to have to evaluate whether that's a viable option too. I mean, we could certainly look at what stick over podium would look like. I can't say, knowing the geometry of that site, whether or not it really works for that configuration. Usually the way that those are organized, you have some kind of courtyard element. There are things that make them more livable, workable for the market target here. I think you don't get as much rent. So it's not all positive on the cost side. You have an impact on the revenue side when you go in that direction. And again, not being an architect, I'm not sure I could opine as to whether or not the site geometry with a hotel gives you enough room to do what you need to do to make that approach work.
You're talking just about the apartment building, not the hotel.
No, I was talking about the hotel. The apartment building is still 13
Much
stories.
too high.
Yep.
But the hotel is sort of looks to me like it's within range or close, and there's been a lot of interest. It seems to me half of Boston recently has been this method of construction. And
In the suburbs, yeah, that's true.
no, I mean in like South End, South.
Well, in the
Cleveland
south,
Circle.
in
Yeah,
South,
Cleveland
in
Circle.
big block, when you have a big block, you can
Yeah.
do it.
I'm
Yeah.
not an expert. I just go to seminars, so I've never built with it.
Yeah.
But it certainly, I'm just asking from a cost point of view if
Yeah.
it's potential cost savings.
Well, they can be made feasible. I mean, that the reason that people are going to that approach in some places is that the rents aren't high enough to enable steel
Masonry.
construction, to enable support for steel construction. So it's not, we see it in places like, as you're suggesting, South Boston on West Broadway. We see it in Mattapan. We see it in Roxbury and JP.
But you don't see
Um,
9
Cleveland
stories.
Circle.
But
You don't see 9 stories.
no, because the rents aren't high enough to
No,
support
it's
the
not
cost.
legal, not allowed, under the code.
It's I think you have to
Well,
be
yeah,
self.
it has to be seven stories, 70 feet. 70 feet is
It's 2 podium
Yeah,
plus 5.
plus 5, 2
And
plus
then
5.
That's correct.
And you have to be under 70 feet.
Right.
That's the other problem.
That's the threshold, is 70 feet.
You have to be under 70, which
Yeah.
means you
They're
have
doing
low.
it in
which-
both New York and Portland right now.
That's cross-laminated timber
Yeah.
though, and that's actually more expensive than steel construction. Like it's not. I don't think those are equivalent products.
If we're doing curio or canopy, like Hilton's trying to encourage us, they wouldn't accept it. If we want to do some homewoods or, which is not what we want to be doing in this location, we want to get better heights in the rooms,
Mhm.
and so that's what they've encouraged us.
I'll point out in Cleveland Circle, which is 4 to 5 stories, it's steel.
Yeah.
Oh, really?
Yeah.
The residential is wood.
Oh, okay. Ken?
Yeah, please. Pam, I know this question is going to come up when we talk about the
Yeah.
height and scale of the residential tower. The numbers you gave us would translate into a sale price per square foot for market square feet, not counting the subsidized, of about $750 a square foot for the apartments. And we know condos are sell for significantly higher, over $1,000 a square foot. So what would the cost implications be? So obviously the total sale proceeds could be higher through condominiums. What would the cost, in terms of gross sale proceeds, what would the cost implications be on construction in general? Like you typically think of higher slab to slab
Definitely.
spacing for condos,
Higher finish.
higher finishes, and also
More sound
probably the
attenuation, yeah.
marketing costs are higher. And how would that net out? And sort of getting to a bottom line, if you said, well, if they're all residential condos, it could be 12 stories instead of 14. How would you respond to that question?
Yeah, so the analytics for that, as you accurately point out, you end up with higher revenues, you end up with higher costs, and the return requirements are also higher, dramatically higher. You have to be able to get something on the order of 30% profit margin in a condo deal in order to shoulder the risk of absorption, sale absorption. It's with an apartment, you get the chance to work your way out of trouble because you own for longer, and you get your returns on that timeline. Whereas with a condominium project, you have basically 12 to 18 months to make your money, and if you do not succeed, then you are in foreclosure world. So as a result, the threshold requirements for returns are very substantial. Now, I haven't modeled this to look at condo and see how much room there might be, whether you're net to the good with that scenario or not. But I think, this location obviously could be a condo location. I think you end up with a different product. You end up with much larger units. You end up with the need for a minimum of one, going to 1.5 per unit for parking. And I think it becomes a completely different animal. It's not just a matter of swapping out the current program for buyers. And it probably can't be more than 100 units. 80 to 100 units is probably as many as you would tempt the fates on. It's very unusual for a condo program to get much more than 100 units. Dick Friedman is doing 168 or something at One Dalton, but you get Courage to do that because of the economics and the power of the hotel below. So it would become a different thing.
Okay, well, it's approaching 9 o'clock. So I've been fascinated by this.
That's not a good. I don't know, Neil.
But I guess I don't know if it says about me.
I wasn't going to say anything, but that's kind of what I was intimating.
But we have some pressure points that we can explore. So we're set to meet on the 18th for those who are in town. I'm going to leave it to Kara to arrange for a architecture subcommittee meeting, which is where I think a lot of this is going to be explored, and then that group will hopefully come out of that with some options for us to consider.
Yeah, and if there are if other questions arise, like this question about the meals and room taxes, that's a number I can generate easily, quickly. But if there are other scenarios that need testing, you'll let me know.
Right, and that should go through Kara.
Mm-hmm.
So Kara's the point of, or Francisco.
No, Kara.
Kara.
She's not here yet. Also, a reminder that there are upcoming meetings that are on the agenda, so if you want to take those with you. And then in July, we're discussing traffic.
And Sergio?
I just had one question, which I'm just unclear on. In requesting that the architectural subcommittee get together, has this been coordinated with the proponent, and are there new drawings that are being prepared?
I believe so.
Yes.
Do you guys have a date? Because the last email we got from Kara was that we.
Okay, I'm going to defer to Kara when she gets back from vacation to arrange for mutually agreeable
And
meeting
make sure she
times.
tells all of us when it is.
Okay,
When what is, I'm
The
sorry.
meeting, the subcommittee meeting.
Oh, okay.
so anyone who's interested
Yeah.
can attend and provide
Thanks.
input.
My pleasure.
So I'd like to thank Pam.
Sure.
Great job.
Thank you,
Good job.
Yeah,
Thank you.
absolutely.
Thank you.
You're welcome.
Thank you, everybody.
$18.